I'm Keith McCullough, and welcome back to the Investing Summit. We're going to meet with the man, the myth, the legend, Brian McGough, the guy who's been one of my partners since the very beginning. For those of you who haven't followed him on Twitter, it's at Hedgeye Retail. That's where you can find a lot of his flow, and he's got a lot of flow when it comes to ideas, long and short. Brian thinks big, and this session is going to be a lot about the macro meeting the micro, or us top-down macro people being Darius and I, and Brian McGough being the sector head professional who's picking stocks from the bottom up. So thanks for doing what you do, and maybe a good spot for you to just kind of take 10 minutes, 5-10 minutes, and go through what you see out there today.
Got it. Cool, thanks. So I want to walk through a couple of charts here, and really, as Keith said, I just want to sync what he's saying macro-wise where I'm coming up micro-wise. We usually are around the same area, the key ballpark is as far as where we end up with stock ideas. I have some, I think, which might be a little different, and I want to explain why. So the first thing I want to hit on here is this chart, which I call my Sigma analysis. Now, this is going to look a lot like something you see out of Keith and his team, which Darius worked really hard on. So I think we copied a little bit of each other's stuff, and we got
quadrants. Those are quadrants, right?
We got so look. On the vertical axis here, this is really important. This is your sales to inventory spread. So you always want to be as high as possible here. It's the sales growth minus your inventory growth. Let's just say sales are growing plus 10, inventories are growing plus 4. You're going to show up at a positive 6. And I guess here it's a positive 4. It's as high as it's been over the course of 2 years. So the point is, sales inventory spread is really, really positive. On the horizontal axis, let's just flip back and show that chart one more time. You see the year-over-year change in margin. So what you want to be is on the right-hand side of that chart and not on the left-hand side of that chart. My sweet spot is in that upper right-hand corner. That's where sales are better than inventories, margins are up, life is great. These guys are selling everything, and they're selling a lot of it, and it's at a great margin. What's very unusual is being in quad 1, as I'll call it, cleanup mode. It's where you're cleaning your balance sheet, and it's where you're getting ready for some big move. Usually you're in that quadrant for 2 quarters tops. We've been in there for 5. So I view that as almost like a bow and arrow. This thing is cocked. It's just being pulled back further and further and further, and it's getting ready to just go somewhere and go somewhere really, really fast. I marry that with quad 4 on your guys' side, and I come up with it going down. And if you go down to your quad 4 and our quad 4,
and you mean it can't go up beyond the top right corner of the chart?
No, it can't do that, and I'm not resetting the axis either. So I'm not overly worried about sales. I just want to put it like clear there, because I think sales expectations are kind of okay.
Yes. You're talking about retail sales.
I'm talking about retail sales on a bottom-up basis for the Targets and the Walmarts and the Kohl's and all those guys. I am very worried about margins for a couple of reasons I'll hit on, and I'm worried about inventories, which flows back and turns into a margin problem. So I want to hit on sales expectations first, and this is on the following slide. So what you see, and this is why I'm not overly worried, on the left-hand side there, I know the chart's a little messy, but you see your black line, which is what sales growth have been on a bottom-up basis over the course of the past, 6 or 8 quarters, and they've looked stellar. Now expectations do have them coming down over the course of 1 quarter.
It comes down fast.
It comes down fast, yeah. So I look at it and I'm like, okay, I think the sell side maybe has got it okay. They got it in their numbers overall. The dots, however, show the 2-year trend. So the 2-year trend, looks okay, but then obviously expectations are things are just getting better. On the right-hand side, this goes from a trend duration over to a tail duration, and it shows you that the street is looking at sales expectations just pretty much going up in perpetuity.
Yeah, so for those of you that don't know the difference between a trend and a tail, at Hedgeye, a trend is 3 months or more, so quarterly data, which Brian had on the left side of the chart and on the right side of the chart. Correct me if I'm wrong, but tail, which is 3 years or less, it's annual expectation. So not surprisingly, after 9 quarters in a row, what you're saying is 9 quarters in a row of U.S. growth accelerating, which has never happened before. Retail sales have accelerated for 5 in a row, the last quarters. And Wall Street's modeling that out as continuing as far as the eye can see.
Because that's what they do.
Yeah, that's cool. All right. That's good that they do that.
Yeah.
If you're on another channel, where you'll now have to stop for a commercial. You will note that it's just a bunch of head bobbing and talking about what happened yesterday, as opposed to having accurate forecasts in the future. So,
right.
Thanks for that. That's a very different view that you have.
Well, one thing I want to show, and this next slide is key. Park on this thing for like a solid 2 or 3 minutes. So there's
People are gonna have to.
there's a lot going on here, and stick with me. What it shows is back, over the past 9 years on a monthly basis, the monthly retail sales dollars, the incremental, like year-on-year change in retail sales dollars for brick and mortar versus e-com. You see that dark line in the background, that's your e-com sales.
Just going, it's secular up and to the right.
Right, and it's fair. What do you guys think e-com sales grow?
30?
Actually grow mid-teens.
Yeah, I was gonna say 14.
Yeah, so it's a lot less than most people think. In the worst environment going, it'll grow at 11, 12, or 13. In the best environment going, it'll grow at 19 or 20. So it's actually locked in between a band there. That's its behavior very, very repetitious, just over and over again. The impulse purchase, and this is back on this chart here, like when we have a lot of extra money in our pocket, we actually go to a store. And on this chart, what really bothers me. Yeah. So you see the blue line, and you see what's happened over the past 12 months. The mall visit has shot right up.
Booyah.
And it's actually gone, as far as incremental dollars, past what e-com has done. So we have to see, remember last year, of course you guys do because you do macro, when we had 6.9% comp in holiday of last year, it was just monstrous. In order for us to not see a big rollover in that trend and have the accrual come away from brick and mortar, we have to see that happen again.
Against again.
It's got to happen again.
This isn't miracle. Again!
No,
it's not going to happen.
No. So this is like a really key chart. This is like, will brick and mortar ever comp again? It might not ever comp again, like ever. It's just something to throw out there, but it's very, very bearish.
Right after, Brian, almost every hedge fund that's had performance issues this year, you can call it whatever, you can call EPI, it's some kind of performance issue dysfunction. The reality is that a lot of hedge fund managers got fired for missing this move.
Yeah.
Because they couldn't believe that brick and mortar crap retail, as I affectionately call it, actually could comp.
Yep.
But from here, now that people have lost their jobs, been squeezed and covered their shorts, what if they just don't comp?
That's right.
That's the point, right?
Right. Well, one of the interesting things, and I'll hit on this in a minute as far as inventories go, is that the retailers are budgeting for a 3% comp. So you got to think about that. This product is made, it's on the water, it's getting ready to be put on a truck and brought over to a store. So it's showing up and it's getting sold. The question is, what does it get sold at? Which brings me over to margins. And that's this next chart here, which kind of blows me away. So, okay, next quarter is in check. I get it. I'm not overly worried about what we see in November. I'm worried about the guide that we see when all these numbers start coming out in late November. Of course, the street is looking for margin expectations just to go through the moon. I have a slide next. Don't flip there yet, but it just shows labor. I mean, like store labor is absolutely crazy. So you have
the
retail.
Wage inflation.
Yeah, retail wage inflation is exceeding core U.S. wage inflation by a country mile. So that's a big problem. Go back to that slide again because I got to point you to the right-hand side of that one. These are consensus margin expectations on the right-hand side. So we were just talking quarterly, and they're very aggressive. Now let's talk annual. Again, we're going from trend over to tail. We saw, I'm going to count here, 1, 2, 3, 4, 5, 6, 7, 8 years in a row of margins going down or the rate of change getting worse in one of the best macro environments that we've seen in God knows how long. And now we're late cycle, we're going towards quad 4, and now the street's looking for margins in 18, 19, and 20 going up.
Straight up.
So at the same time, they should be
banking business, brother.
the same time they should be decelerating on the downside is when expectations have them accelerating on the upside, and I just have an inherent problem with that. You can't be intellectually honest and actually build a model and go through every part of your cost model and get to cost deflation. It just won't happen.
No.
But you could get the next banking deal.
You could get them. Yeah, you could get them.
Just got to show them a nice upwardly sloping chart.
And there'll be a lot of them. All right, next slide, tariffs.
Oh boy,
This is actually, a slide after this.
Where's Trump?
So, this is really noisy. The dotted line shows you the change in retail gross margin. The green line, or the green area and the red area, is the difference in the per unit cost. So essentially, you can have per unit costs which are coming down, which you have had at points, but you've had the per unit price that's come down even more,
Yes.
which is accrued to the benefit of retailers.
Yeah.
Totally.
So you always have to look at one relative to the other one.
That's a
right?
good chart.
And what I'm forecasting there is modest tariffs. This is assuming we have our 200 billion at 25%, and that's what's in that model right now. There's almost no mathematical way gross margins could be up for retailers next year unless we pony up and we pay for the extra tariffs. And there's a couple of great stock plays on that. I think Dollar Tree is money, just because of the big change you can see in its pricing policy around that. So I really want to talk about that. But this is a key chart. No one else does it. Why? I don't know. Oh, because it's hard.
The buy side does it.
Yeah, they probably do.
Old wall media, the analysts they interview, no.
Yep. I do it. That's why,
Oh, yeah.
that's why I have
That's why
a
people
job.
pay the big bucks.
Exactly.
All right, earnings, next chart. So all that, we got sales, we have margins, and now we have earnings. Let's go and look at trend versus tail once again. So you have here, again, we have a dip on the 2-year run rate in the upcoming quarter, i.e. current quarter earnings look fine. It's your quarters after that where we're accelerating to a mid-teens earnings growth rate, which will have surpassed anything we'll have seen over the past 4 years at a time when we're going to have an inventory problem and we're going to have a quad 4 margin problem.
Oh, yeah.
So these things just don't add up.
How do you guide to an acceleration there with the dollar up, with wages up, with potentially peaking retail sales? I mean,
Easy. You
just draw a
you
line
hand
that
the
shows
analysis.
draw a line. No, seriously, how does someone build a model with those input costs?
You have your junior associate do the model and you bless it. That's how you get there.
Yeah.
But look at this though. On the right-hand
Just like how you
side,
find a gold mine, you just keep digging.
Just walk outside.
right-hand side of this is tail. So earnings growth for retail specifically, 3 years in a row, have grown at less than 1%.
Wow.
And now, when we're going where we are, earnings all of a sudden are going to grow in the, let's call it the high single digits. I'll give them a gimme on that mid-teens number there, because it's 18 and we've already banked a part of that. But how does that happen? I just don't understand. So look, I'm not being a cynic just for the sake of being cynical. I'm just doing bottom-up math. I'm looking at where the consensus numbers are. I'm looking at where reality is from a consumer standpoint, a macro standpoint, and they simply do not match up. And I don't have a valuation slide on here, but I'm telling you, valuations don't match up either. There's a lot of great shorts here, a lot of great longs. I got them on this next slide here, and we could hit on them. If there are any questions on any of these things, please knock yourself out. There's a lot of ways I think we can make money on this.
Yeah, so for those of you that are looking at that, those are all the names that Brian McGough and his team, his 4-person research team, follows actively and has conviction in, either on the long or the short side, the longs being, of course, green, and the shorts being red. I came up with that myself. Ultimately, there's a lot to think about, though, especially when you think about like what we talked about from a short selling perspective with Andrew Leff. We talked about with Chris Whalen in terms of the cycle. So if we are indeed at peak cycle, Brian, your group might be one of the best groups, happy hunting on the short side, and a lot of these crap retailers have had huge moves.
Yeah,
so if you were to take that group and you're just to pick your, this is kind of a leading question because I think I know the answer, but nobody else does until you answer it. What is your favorite crap retail short with market cap?
It's Kohl's.
Yep.
You knew that.
Well, there's some alliteration. I thought you were going for.
I might have been going to Hanes Brands, but about the crap. No. So Kohl's, great short. $5.50 in earnings power right now. $1.70 comes from credit. $2.25 comes from egregious lease accounting, and $1.25 comes from a subprime customer. You add all those up, and you get to $5.20 in fake earnings, and the street thinks it'll do $7 a share in a couple of years.
They've gotten to 7 now?
Oh yeah, the street's $7.
Wow.
Yeah.
Okay. Now on that number, it's cheap, bro.
It's sure. Yeah.
You know, that's the other thing I want to make sure that all of you, and again, thanks for joining us. I mean, those of you who haven't worked in the hedge fund industry and shorted stocks, what you want to find are fake estimates. So you want to find people that have a forward outlook that reflects what happened in the rear view, which Brian just laid out, which is an acceleration, and just extrapolating the acceleration effectively as far out in the future as the eye can see.
That's right.
That's called a sell side's model, or that's called an investment banker's model, or it's called somebody who's on TV who's perpetuating one of those two things, or both. So at the end of the day, you want to be very careful of that. And the big opportunity for short sellers is when your number on a forward outlook is going down and theirs is going up. So that's effectively what you're saying.
Right. So the street is saying, hey, these things are cheap, trading at 12 times earnings. I'm saying, no, they're expensive. They're at 18 times earnings.
Yeah, exactly.
And that's where we are with Kohl's.
But this whole this whole thing that people, and I feel bad for people, some people that are watching this for the first time because they've been this whole old wall way. You know, you can't listen to these channels without hearing, oh, but if you look at it on valuation, and they'll just like look it up on Yahoo Finance, see the multiple and call it cheap if the multiple's low, they'll call it expensive if the multiple's high. That means nothing, okay? That means absolutely nothing. My fourth grader can tell you exactly whether or not on those parameters a stock is cheap or expensive. What my fourth grader can't do, or a 12th grader, or somebody who's even been in the business competing with you for a decade, never mind the 2+ decades that you've been doing this, is they can't tell you whether it's cheap or expensive based on the right number. Okay, the right number is super important here. So who's got the biggest delta on downside numbers relative to your forecast? Is it Kohl's that has the most downside?
Kohl's has the most downside. Carter's comes close.
Carter's. Oh, that's an awful looking chart.
Yeah, it's an interesting one right now.
CRI.
Yeah.
Cry for me.
Yeah. Carter's
Been there many times. I have 4 kids. We can come up with qualitative reasons on why we like the company. Blah, 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 blah.
Every new dad I talk to, oh no, it's a great brand. I got it. It's a
Okay.
great brand. It's a crappy stock. So there's just a big difference. So Carter's the first
You don't
time,
shop there.
the first time in 18. No,
No, not.
not yet. Not that you're aware of. So in 18, it's going to have a flat year. Scratch that. I'm wrong. In 18, it's going to have earnings up in the high single digits, and then it's going into a flat year in 19. We're going to realize that in the fourth quarter earnings numbers, which is going to be a disaster. This thing trades now. It's come down. It's been working, but it's still trading at a 15, 16 multiple. This is feast or famine. Trades at a 20 multiple when it's actually growing, trades at a 12 multiple when it's not growing or it's flat. And there's a $75 stock, and right now it's $98. And it looks horrible from you ride on it every other day. You probably ride on it.
I just shorted that.
You ride on it more than me.
Real-time alerts.
I know you
do.
Yeah.
So Carter's big downside there.
There's, I mean, my daughters wear Peppa Pig shirts from that place, but it doesn't matter. It's still an oinker.
Yeah.
And that looks terrible. Before we take questions, long side, you mentioned Dollar Tree. What's the deal there?
Dollar Tree, there's a lot going on at Dollar Tree. This is a story of 2 securities. It owns Dollar Tree, which is a core concept where our wives might shop.
Yep.
It's like a treasure hunter type thing. Everything is $1. You go in there and you can buy like a wrench for $1. You go to Home Depot, it's $5. They find these great values and great closeouts.
Batteries.
And it's a good concept.
Pampers.
Problem is, it's the biggest exposed to tariffs. So everything in that store is at $1. But there's a clear example, a company called Dollarama, who had the same concept, and they broke the $1 price point. You have an end cap, and you say, hey, here's an iPhone charger with great value at $350. It's still amazing value at that price point. They're going to have to break this $1 price point. Once they do, you have about $60 in optionality on the stock off an $85 stock.
Because they're just selling things for more than $1.
Right, which is perfectly okay. They're not going to fire their customer, and it'll be well received.
Well, the customer will pay more than $1.
Oh, yeah.
But the stuff's not in there for more than $1.
No, it's not.
So milk, like stuff like that.
There are certain things they can't sell. You can't buy a diaper at a Dollar Tree. So you can't buy formula. You can't buy electronics. You can't buy a football. So it just gives them a lot of optionality to go into a lot of new categories. Big idea. You've got the CEO who's out there telling shareholders, no, we can't, we don't have to do that. We don't have to do that. And then a couple of weeks ago, he testifies in front of Trump saying if tariffs go through, it'll be a disaster for our business model. Like, you're telling one side one thing, another side another thing. The punchline on this whole story is there are many ways you can win. One, breaking the $1 price point. It will take an activist, I think, in order to get that done. Then 4 years ago, it bought Family Dollar, which is a piece of crap. It's like crap tail, right? So it had that, and it hasn't done anything. You have what has been the best management team in retail at Dollar Tree. It's moved one individual over to Family Dollar over that time period. It simply hasn't moved fast. It hasn't leveraged any executives. The store managers, you've got 9,000 openings for store managers for a company that has an 8,411 store base. They have a problem with employment. They aren't paying enough. They're not merchandising stores appropriately.
Wow.
I have a full deck. I have a full activist deck which walks through all the ways you can fix
it.
Right. So if you do either of those things, you get 250 in earnings power incremental on top of a 650 earnings annuity. So if both of those things happen, this is a $200 stock. And it's 80 now. And if it does nothing, then you're looking at 550, 575 in earnings on a 12 multiple. It gets you what, like a $68 stock. I'm not saying that I wouldn't be incredibly pissed off if I saw a $68 stock over 85, but this is one of those opportunities. You can't find something like this in public markets right now. And that's why
something that's with market cap.
Yeah, it's got cap. And we did a deck on this thing here. As far as how these decks go, we are in our studio here and we get all energized and we do our deck and we go through our 80 pages of why something's a great idea or a bad idea. The number of activists that we had clued in on that call was off the charts.
Yeah.
So tier one activists are sniffing around here, and I'm not banking on another guy going out there and doing the work. I got to do the work. That's my job. I'll point it out, and let's see if someone follows. I'd be very surprised if we didn't see anyone follow. And what's funny on this one is that investors are like, yeah, I got to be patient. If I see an activist step in, even if it's up 10% that day, I'll go and I'll buy it. Well, guess what? If everyone thinks that on the day an activist goes in, it's going to be up 20%.
Yeah, come on, guys.
Yeah, totally.
Guys. 2 and 20, you don't get paid to wait like that. Yeah, strap it on. Somebody go for it. I mean, seriously. I mean, this is the hedge fund business. You gotta step up. Come on. These good ideas are hard to find. Anyway, even I can understand this idea, which makes it pretty simple. So this is and the other thing I like about it, and it's a good risk management idea. When you're on the backside of the cycle. So to come full circle on this, I'm not going to short a stock that's already imploded, and I'd like to buy stocks that have already imploded, okay? Because my downside, just quantitatively, is less after it's gone straight down. And in this case of Dollar Tree, I'd be looking at buying a stock, and again, I'd use the risk range to buy it appropriately. Yep. But I'd be accumulating the stock on days that it's at the low end of the range, and I'd be shorting the living daylights out of the Kohl's and Carter's when they're at the top end of the range. That's how you should do 2 and 20 work if you want to get paid. Anyway, that's my rant about that. Let's take a couple questions, and then we're going to have Todd Jordan in I think in 5 minutes.
Yep, absolutely. Let's start with the top down, and we'll be quick here. I'll start with the top down and then sort of finish with a couple more bottom-up ideas. Where do we stand on your retail apocalypse now thesis?
Apocalypse.
We're there. I mean, there are these factors building up. That one slide I showed, the incremental dollars.
Yes.
You know, I drew a line. I said this is when we're at a point where we have to see a meaningful ramp, and we have to see a 7 comp again in order to have this trend not roll over. We're right there. Apocalypse is now.
Quad 4 in Q4, I can't say that enough times. Quad 4, growth and inflation, it goes from accelerating to decelerating at the same time. Quad 4 in Q4, and Brian's got the same view from a bottom-up perspective in a second.
Yeah, totally. So we have 3 slides in our macro deck that we can sell to you and you can license for your retail deck. The one is
I'm not paying you a royalty.
No, it's all good. The first slide is on slide 29, where we show the growth rate of retail sales control group. And we run a scenario analysis on projecting that forward using the 2-year average sequential momentum for each successive month. And what you learn is that retail sales will peak if you did the exact same thing your Apocalypse Now chart just says. Again, the year-over-year rate of change is going to decelerate. So their call is that we're not going to do that again. That was obviously an anomalous event that's unlikely to happen. The second slide is that wage growth does not equal inflation, certainly in the short to intermediate term. And the chart that's probably most sort of bearish for a lot of these crap retailers is a slide I snuck in the back of the deck in the appendix. We were in California last week. Was that accelerating wage growth does not translate into accelerating retail sales. Historically, that's actually a slightly negative relationship on a trending basis. You typically see wage or retail sales growth peak ahead of wage growth across many cycles. This is data going back 30 years. My take on that is that consumers shop, in an aspirational manner rather than, from an income-based manner. But I'm sure there's plenty of other theories. But
and you have wages up and often hours down.
Hours down, exactly.
Because these guys are managing to a wage
growth
number.
is actually decelerating.
Yeah.
So that tends to be. So those 3 things are obviously not very positive on the long side of crap retail from here.
Crap retail.
Yeah.
If it ain't Irish, it's crap.
Totally.
Kohl's. If it's Kohl's, it's crap.
Exactly. All right. So 2 companies
They hate us.
Yeah.
Those Kohl's guys.
Oh yeah.
Kohl's.
Yeah.
But you know what? If you go to Kohl's, you'll hate it.
I've never been
Next
to a
question.
Kohl's. I'm in my early to mid 30s.
You're not the customer.
I've never been to a Kohl's. Probably never will. Walmart versus Amazon. Which stock would you pick in the long term?
Which one would? All right. So Amazon. I will say this though. Here's like a talking out of the other side of my mouth point on that one. Amazon needs stores. A lot of people don't realize how and what's going on, but it is building its own stores. These new DCs, it builds a 1 million square foot DC. That DC could actually become its own mall, like a 1 million square foot mall.
Jeez.
That comes up out of nowhere. So this is a big theme out there. So Amazon needs stores. Why did it buy Whole Foods? Because it needs stores. Why will it probably buy Dick's Sporting Goods? Why should it buy Best Buy? It needs stores, and it needs them in the secondary and tertiary markets. But I've got Walmart on the other end where it needs e-com. Am I going to trust Walmart more to build up a successful e-com business, or for Amazon to build a store business? I don't know.
Yeah.
I'm not sure if I know the answer to that question. I mean, Walmart's been investing a lot of capital. I'll bet against a lot of management teams in retail. That's one I won't bet against them. I mean, these guys are no dummies, and they've hired a lot of great people, incentivized them in a lot of the right ways. But I mean, let's face facts. Amazon is Amazon. We try to make our mark instead of saying it should trade at like 1,000 times an earnings number we'll never see. And I don't want to pick that magic multiple and have a $20,000 price target. I want to make money on the ecosystem.
That whole argument, though, the magic multiple, what is Amazon worth, lived in an environment of 9 straight quarters of U.S. growth accelerating and retail sales growth accelerating to a cycle peak. So you can get as creative as you want, and that's how these bubble multiples were built.
Yeah.
I'm not saying Amazon's a good or bad company. God forbid I actually said it was a bad company. I don't have any business saying that. I'm just saying that when it slows, when you're in quad 4, you buy Walmart and you short Amazon. Actually, that's what you do. And in the second quarter of next year, when we're no longer in quad 4, you buy Amazon and you short Walmart. Like that way, you don't have to have this passionate belief that these stocks that you love are like your spouse. I mean, you love your spouse. I love my spouse. There's wants a spouse. Everybody's got great spouses. But I don't want to love a stock like that. I just don't. I mean, and you can fall in love when something doesn't change for a long period of time, and that was growth.
Yeah.
So anyway, we could talk to you forever, but now we got Todd Jordan knocking on the doors.